We are going to attempt a text spanning question for 10 marks. Scenario is you should assume today's date is 20th March 23. This date is like 15 to 16 days before the start of a new fiscal year, which is fiscal year 23-24, which will start on 6 April 23. Before the start of the fiscal year 23-24, we have to assume that today's date is 20th March 23. Standing on this date, Sammy Smith, who is a director of a company, and the company name is ICMAP Limited, the company has given her the choice of being provided with the leased company motor car, or alternatively being paid additional director's remuneration and then privately leasing the motor car herself. Basically, the scenario is a company and employer wants to like accommodate employee for commuting purposes. Employer wants to accommodate the employee, and for this purpose, employer is considering two alternatives. First one is providing employee with the company car, and the car will be a leased car. Lease means a rental car will be provided to employee, and the rent will be paid by the company. Alternatively, company is like deciding whether we should providing the car to employee, or we can increase the employee's salary, and then the person would be like arranging and managing the commuting herself. So that's basically the scenario. If the company will be provided the company motor car, what will happen? And if the additional director salary is provided, so let's start reading the scenario very carefully. The motor car will be provided throughout the tax year 23-24, and its provision will result in a taxable benefit of 30340 for employee. And the employer name is Sammy Smith. Company name is employer name is ICMAP Limited. In first option, where the company would be providing this car to employee, then this car will result in a taxable benefit for employee. The motor car will have an official CO2 emission of 200 grams per kilometer. That's very important to highlight, because this 200 gram per kilometer is more than 50 grams per kilometer. And for businesses, if leased car CO2 emission is more than 50 grams per kilometer, in that case, 85% expense will be allowed and 15% expense will be disallowed. 15% expense will be disallowed. If car CO2 emission is more than 50 grams per kilometer, then the annual rental cost of the company from this 27720, that's the annual, because this car will be leased by ICMAP Limited and its annual rental cost will be 27,720, from which 85% will be allowed expense and 15% will be disallowed expense. Means when the company would be preparing its accounts, then from 27720, 85% expenses can be claimed as allowed expenses. Furthermore, the lease payments will cover all of the running costs except fuel, and ICMAP Limited will not provide with any fuel for private journeys. Simply means if the car is provided, only the car usage benefit will be there, and no need to calculate it because it has already given in question as 30340. And if the additional director's remuneration will be given to employee, then what are the implications? Let's start reading. As an alternative to having a company motor car, Sammy means the employee will be paid an additional director's remuneration of 28,000. This word shows that the employee is already getting a salary, but in this option, an additional 28,000 of the salary will be provided during the tax year 23-24. And then using this amount, using this additional compensation, employee will then privately lease the motor car. And this additional information is pertaining to the whole question. It's not only pertaining to the additional director remuneration. Such additional information is required, is pertaining to whole scenario. So in this other information, it is mentioned as Sammy's employee's current annual director remuneration is 65,000, and ICMAP Limited prepares account to 5th April each year. By the way, this director remuneration existing, the current director remuneration, based on this we can say that person, if we talk about the income tax implications and being getting this salary, director remuneration is a gross cash earning, employee has to pay the income tax liability as well as class 1 primary NIC. Class 1 employee NIC is also paid by employee on this current remuneration. If you look, this 65,000 suggesting us that the current employee status will be for income tax liability purposes. Employer would be paying taxes at 40%, because from 65,500 to the extent of 37,700, 20% tax, and any amount which is more than basic rate band limit of 37,7%, the additional amount, the amount which is in between the lower and the basic rate band and the high rate band limit, on that taxable income 40% taxes will be applicable. Plus, at the same time, if person's gross cash earning, if employee gross cash earning is like based on the existing gross cash earning, employees gross cash earning is 65,000, on this amount for the first, from this 65,000 for the first 12570, that's nil, and any gross cash earning falling in between these two limits, 12570 till 50270, to this extent employees already paying NIC of 2%, and from 50271 to 65,000, on this difference employees already paying NIC at 2%. If any amount is further given, if any X amount is further given to employee as a salary, then in that case, on the additional salary, on the additional gross cash earning, plus on this additional gross cash earning, NIC will be further calculated at 2%. No need to calculate from scratch. If you receive any amount, for example 28,000 of cash received along with 65,000, if under option 2 salary is increased, then the NIC will also increase by 2% only, because from in between these two limits, employee already existing, or in existing circumstances, employee is already paying NIC at 2%. If any X amount, for example 28,000, is further given to employee, the NIC will be increased by 2%. So we have decided two things based on the 65,000 salary, based on current annual director's remuneration. We have decided that the person's tax rate is 40% and person is paying class 1 employee NIC at 2%. And in case if further gross cash earning, for example in option 2, if further 28,000 salary is given to employee, in that case the tax will be increased by 40%, and plus gross cash earning will also be increased by 2%.
If you don't like.
What is the requirement? Here we have first requirement: advise Sammy Smith, advise employee of the income tax and NIC implication for this tax year under option 1 and option 2. What is option 1? If the employee is provided with company motor car, and what will happen if employee receives additional director remuneration of 28,000? We have to advise employee. Advice is required for employee. So we have 40 steps to follow here. Sammy Smith is the name of employee. For this employee, we are basically checking the tax implications under these two options. If the salary is, if the car is given, and if the increased salary is given, what will happen with the employee? So let's discuss for employee under first thing, provided with the company motor car. If the car would be giving to, if the company is giving car to employee, this will result in a taxable benefit of 30340. Apply this situation on yourself. You are the employee of a company, and if company is giving you a car, what will happen? That car will give rise a taxable benefit. If there is a taxable benefit, will be added to your employment income. If employment income is increasing, ultimately your tax liabilities will be increasing. At the same time, think from the perspective of employee. NIC, is there any NIC impact? Is there impact on the NICs on the employee? No. Why? Because it's a taxable benefit. On the taxable benefits, employees do not pay any NICs. On the benefits amount, employer pays class 1, employer pays class 1A NIC, but not the employee. So let me write Firstly, we establish that what will happen with the income tax liabilities and what will happen with the NICs. So I can say that no impact on employee NIC. Let me give you the reasons why the income tax liability will be increased, because there is a taxable benefit. If this taxable benefit is that's a taxable benefit for employees employment income will increase, and increase in income, increase in tax liabilities. So this will give rise in the tax liabilities based on the current salary. If an amount is further added to the employment income, the tax liability will further be increased by 40%. So 30340 into 40%. So the tax liability increase is calculated as 12136. At the same time, why there is no NIC impact for employee? Because let me write this point. Employers do not pay any NIC on the benefits received. Employers do not pay any NIC on the benefits received. Rather, employer, ER stands for employer, pays class 1A NIC on providing the benefits. Here, you are thinking from the perspective of an employee. Sammy Smith is an employee who is getting this benefit. She will not be paying any NICs on the benefits received, because employers do not pay any NIC on the benefits received. Rather, employer pays class 1A NIC on providing the benefits. Hope this thing is very clear. That's the first thing for Sammy on getting the car as an additional benefit. So these are the implications. Sammy's income tax liability will increase, plus at the same time Sammy NIC will not be impacted because Sammy is employee, and in this case employee will not be paying any NICs on the benefit received. Now think, if instead of providing a car, if salary is increased and if the employer is given additional salary of 28,000, yes, for surely employee liability will be increased. At the same time employee NIC will be increased, because why employee NIC will be increased? Because that's a gross cash earning. On gross cash earning, employers also has to pay NICs, and if existing gross cash earning is 65,000, employee is already paying NIC at 2%. I have showed here that if existing gross cash earning is 65,000, on this amount already till this extent employee is paying NIC at 2%. If any further amount is given to employee, then on the additional amount, for example 28,000, NIC will further be increased by 2%. Considering this thing, I have marked that NIC will also be increased, because that's the gross cash earning. An employee is getting an increase in the gross cash earning, so there will be an increase in the NIC payment. So what will be the impact on the income tax liabilities if 28,000 is added to the employee's salary? That's gross cash earning. Income tax liability will further be increased by 40%. No need to calculate the tax liabilities from scratch, because based on the existing salary already, if the person is paying taxes at 40%, we just need to compare with the additional things which are given to employee in current situation. If he is given with 28,000 as additional director remuneration, so we will say that 11,200 will be the increase in the tax liabilities. At the same time, on getting the additional gross cash earning of 28,000, NIC will also be increased by 2%. So that's an increase as 560. On getting this option, if employee gets additional salary, the total tax cost for employee will be 11760. And if the employee will be getting this option, means the employer is providing card to employee, in that case 12136 is a total increase in the tax and NIC of the person under both these options. Now, requirement B of the question is to advise SMARC Limited. Now, the advice is required for company. Advise SMARC Limited of the corporation tax, And NIC implications for the year ended 5th April 24. Company year end date is 5th April each year. And requirement B is to advise the company of the corporation tax and NIC implication for this year end date if company provides employee with the company motor car. And number 2, if company pays employee name is Sammy Smith, if Smark Limited pays Sammy Smith the additional director remuneration of 28,000. Two notes are there. Note 1, you should assume that company's augmented profits are less than the lower limit of 50,000. If augmented profits are less than, we should assume that company's augmented profits are less than the lower limit of 50,000. So that's indicating that that is an indication that the company's tax rate is 19%. When to apply 19%? When the company's augmented profits are less than the lower limit of 50,000, then lower small profits rate of 19% is applicable for companies. Note number 2, you should ignore the value added tax and the NIC employment allowance. Okay, all right. Here the requirement is to advise the SMARC Limited on providing this benefit to employee and on increasing the employer's salary as 28,000. So what will happen? I have given you the footsteps. You need to calculate that what are the implications for a company under this option, and also under this option what will happen with the company on providing the car as benefit, and what will happen if the company increase the employer's salary. If company would be providing car benefit to employee, so there will be increase in expenses for the company, for the employer. And at the same time, if companies expenses are increasing, these expenses will be reducing the profits. If profits are reducing, lower the profit, lower the corporation tax liabilities. So what are the expenses which will increase in this situation on providing the company car to employee? First expense, car rental expense. And remember, annual cost of car is, that's a rented car, that's a leased car, and annual lease for this car, lease rental is 27720. We have mentioned a point over here. If rented car CO2 emission is more than 50 grams per kilometer, in that case 85% expense is allowed and 15% disallowed. If we need to write the expenses, car rental expense, how much amount you will write? If you write 27720, you are making a mistake. Why? Because as we have notified this thing that car CO2 emission is more than 50 grams per kilometer, in that case the annual cost of 27720, 85% of this cost will be allowed expense. 23562 is allowed expense. At the same time, employer has to pay, because that's a benefit amount, and employers has to pay the NICs on the benefits provided to employee. Here we have class 1A is paid by employer on the net taxable benefits. If a benefit is paid, is given to employee, employer has to pay class 1A NIC to HMRC at 13.8%. So second expense, by the way, both of these are allowed deductions. Class 1A employer NIC. So what is this? That's class 1A employer NIC. Benefit amount is 30340, on which it is calculated and paid at 13.8%. 13.8% of 30340 will be 4187. In this case, where the company is giving a car benefit, is providing employee with a car, company has to pay the car rental, as at the same time on the benefit amount company has to pay NIC to HMRC. The total expenses in this situation will be 27749. If this is a total expense amount, these expenses will result, as the expense is increasing, profits will go down, and if profits will go down, multiplying with the rate, corporation tax liability will go down. Let me write it. If expenses are increasing, profits will be decreasing, and if profits will be decreasing, multiplied with percentage then the corporation tax liability will go down. How we can say that? If the expenses are increasing by 27749, profit will go down by 27749, and if company tax rate is 19%, tax liability will also go down by 19%. So what is the reduction in tax liability in this situation? That is 5272. There's a reduction in the tax liability of the company when the company, because on providing this benefit, company expenses will increase, and if the expenses are increased, there will be a decrease in the corporation tax liability. Now think for second half of the question. Here company would be paying additional director remuneration, means paying additional salary of 28,000. What are the implications for company in this situation? Again, the expenses of the company will be increasing. At the same time, due to increase in expenses, there will be a reduction in the corporation tax liabilities. So you are requested to quickly calculate what are the expenses which are going to increase in this situation. The first expense is the salary payment. First expense is the salary expense, which is given to employee as 28,000. That's allowable deduction for the company. Plus, at the same time, in this situation, employer has to pay class 1 employer NIC on gross cash earning, because it's the gross cash earning, and on the gross cash earning, both the employee and employer both are both have to pay class 1 employer and employer NIC. As we are working for Smark Limited, as we are working for employer here, so class 1 employer NIC on gross cash earning. By the way, employer already paying a salary of 65,000, as it is evident from the scenario. The existing salary, the current salary is 65,000. If further 28,000 salary is given to employee, then a further class 1 employer NIC is to be calculated and paid at 13.8%. So here on providing the additional salary of 28,000, further additional class 1 employer NIC is calculated at 13.8%. So 3864 is the total amount. Total expenses in this situation are 38,31864. Now the same concept, if expenses are increasing, profits will go down. If profits are going down, multiplying with the tax rate, and corporation tax liability will go down. Here expenses are increasing by 31864, and if profit will go down by the same amount, 31684, multiplying with the rate of tax, that is 19% for this scenario. So what you will say that company's tax liability is saved by 6054. In part A, we advised for semi-smith for employee. In part B, we advised for company, and that's the last part. Here you can see the verb is different. No, it's not an advice. It's determine, means now conclude something. These verbs are very important to understand. That for thank you. That these verbs are very important to understand, because these verbs are required to understand, because what we actually require to do, we can understand by looking at these verbs. If there is advice, means we need to tell about the tax implications. Here we talked about the tax implications for employee. Here we talked about the tax implications for the company. But now the verb is to determine, means conclude something for Smark Limited. This may be asked for employee, but over here this determination, this conclusion is required for company. Determine which of the two alternatives is the most beneficial from the point of view of Smark Limited. Now examiner is asking you to decide that whether this company should provide employee with a car, or company should increase the salary of the employee. Which option is beneficial for company? So obviously both providing any of these two will result in a cost, will result in expenses, but we will be selecting and we will be advising, we will be determining that option in which there is a lower cost for the company. So that is that will be the most beneficial from the point of view of SMARC Limited. We must select the option which will result in a lesser cost for the company. Now, how we can determine if company will provide a car to employees, so there will be cash outflows. If company provide additional salary to employee, again there will be cash outflows. But in first situation, first cash outflow will be the rental. Although the total rental amount is 27720, of which 85% was allowed to deduct from the company's profits, but at the same time employer will be taking the full amount of rent. Employer will not be charging a lesser amount from the 27720, although based on your accounting concept, your taxation concept, if car CO emission was more than 50 grams per kilometer, so that car rental was allowed 85% to be deducted from profits. But at the same time, the supplier, the owner of the car from whom we have taken this car as rent, that supplier will demanding the full rent of car as 27720. That's the first cash outflow in this situation. At the same time, company is providing a benefit to employee. Company has to make another cash outflow to HMRC in the form of NIC, that is 4187. So the total cash outflows 27720 to the owner of the car, and 4187 to HMRC as NIC, and total cash outflows in this situation will be 31907. And the tax saving in providing car, because this will result in increase in expenses, and increase in expense will ultimately will result in decrease in tax liabilities. So tax liability will go down in this situation one by 5272. So tax saving is by 5272. Net cost for company, under this option is 26635. Think about the second. If company would be increasing the employer's salary, so there is first cash outflow. There is a cash outflow of 28,000 of salary which will be given to employee. This cash outflow is given to employee. And at the same time, that is a gross cash earning. Company SMARC Limited has to make class 1 employer NIC to HMRC by the amount of 3864. So that is another cash outflow on the gross cash earning. The sum of these two will be 31864. At the same time, in this option, company would be getting a decrease in the corporation tax liability by 6054. And if you take the difference, you will get the total cost for the company as 25810. Now decide which option is beneficial for company, where there is a lower cost. You can check the lower cost. You need to select the option lower cost for the company, and obviously lower cost option for company is 25810. That's paying additional salary. In this, if company pays additional salary to employee, then this will result in a lower cost option for company, that is 25810. So that's the most favorable, most beneficial option for company, that company may increase the employee's salary. So this will result in a lower cost option as 25810 as compared to the other one, which is 26635. The same thing can be asked for employee as well. If it is asked for employee, so what will be your answer then? Although it's not asked in the question, but let me guide you with respect to the same thing. If the same thing is asked, that determine which option is beneficial, which option is feasible for employee, whether employee should take a company motor car, or whether employee should choose the option wherein the additional salary is given. So then again, you will be like matching these two amounts and will conclude. And for employee, again, this option is more feasible for option, because here the employer would be paying the NIC and tax liabilities total total tax cost will increase by 11,760 as compared to the other option where the employer is given a company car. In that case, tax liabilities and NICs are increasing by 12136. So again, if it is asked for employer, so we can answer that employer must also take the additional salary because it's a the tax cost for employer is less as compared to the other option. And the same thing is for company, that company must give its employer additional salary because that's a lower and beneficial cost option for the company. All right, moving forward, and on the next slide, we have a few differences between the capital gains tax and the inheritance tax. And thereafter, a quick question with respect to these two taxes. But before attempting the question, let's talk about capital gains taxes and the inheritance taxes. First thing, capital gain tax arises on selling the assets, on gifting the assets, on selling the assets at market value or at less than market value. But all these transactions must be done in life. So capital gain taxes arise on the lifetime transfers, and IST covers both the things, the lifetime transfer as well as the death transfers, the death estate. But in lifetime transfer, there are two transfers. One of them is potentially exempt transfer. The other one is chargeable lifetime transfer. Under IST, all PETs in life are always exempt. But any lifetime transfer, if the transfer is chargeable lifetime transfer, mean any asset is given to a trust in life. If the asset value is more than the nil rate band of the transfer year, then that asset may become chargeable in life. I'm using the word that asset may become chargeable in life. I'm not saying that that asset will always become chargeable in life. No. So mainly we can say that IST is mainly applicable on the death assets estate and the assets which are becoming taxable at time of death due to 7-year rule. If the transfer date and the death date is like less than 7 years, then the assets will become taxable under IST at time of death. Relevant value. Under capital gain taxes, all of the assets are to be reported at market value. Even though the transactions are in between the connected persons, if they are gifting the asset, still any transfer of asset, even if it's under value, if it is sold at less than market value, if it is gifted in any circumstances for CGD purposes, all assets will be recorded at always at market value. But under IST, the assets value is calculated according to a concept named as diminution in state, reduction in state, diminution in wealth, or fall in value of the donor's estate. If you remember, we talk about value before gift and the value after gift, and the difference of these two is the value of gift. So that is a reduction in wealth or diminution in state concept. What are the implications under CGD and IST if the assets are transferred in between spouses or civil partners? For capital gain tax purposes, such transactions are always recorded at no gain, no loss. And for IST purposes, any transfer of assets between spouses and civil partners are always exempt from IST if they are transferred in life or if they are transferred at time of death. All of the assets which are in between connected persons, which are in between spouses or civil partners, they will remain exempt from IST. The importance of timing, yes, it is very important to note that when the transaction is occurred, because need to consider the tax year of disposal that will determine utilization of losses, availability of annual exemption, and for the fiscal year 23-24, annual exemption amount for capital gain tax purposes is 6,000, and rate of taxes for normal assets which are 10 and 20, and for residential property disposal that is 18 or 28%, and for the gains which qualified for investors relief and BADR, then the rate of tax will be 10% irrespective of the status of taxpayer. And the same thing, the importance of timing is yes for IST as well, because we need to consider the availability of annual exemption, and for IST purposes, annual exemption is 3,000 each year. The use of the nil rate band in the previous 7 years, 7-year accumulation period, and the availability of taper relief if the transfer dies within the 7 years after transfer, and if the transfer date and the death date, the time gap is minimum 3 to 4 years time, then that asset which is becoming taxable at time of death, can be covered by a relief named as taper relief, and but the minimum time gap between the transfer date and the death date will be 3 to 4 years, then it will be available. And if donors dies after 7 years, for example, if a person transfer an asset in today's date and dies within next 7 years, that asset will become taxable. If from the disposal date, to be exact, that date, if the time gap is more than 7 years, then that asset will remain exempt at time of death. And furthermore, exemptions under capital gain taxes, we have exemptions like wasting chattels are exempt, low value non-wasting chattels. Remember, for non-wasting chattel, if the disposal proceed and cost both are less than 6,000, such non-wasting chattels are exempt from CDT. And if the main residence is disposed of and from throughout the life, if the person lived in that property, 100% of the gains will be covered by PPR exemption. And if the person has partially occupied the property, then PPR gains will be covered by the relief partially, based on a formula that period occupied divided by period owned into gains amount. And there is also an annual exemption of 6,000 under capital gain taxes. Few exemptions are also there under IST. For example, overseas assets owned by individual and domiciled individual, although there is a this point, but this point is not relevant for TX students. Certain lifetime gifts are exempt up to specified limits. For example, 250 per year per person, which are small gifts. And at time of when a gift is given to a person at time of marriage, then marriage exemption of 5,000 per parent, 2,500 per grandparent, and 1,000 for all other persons. Gift out of income, normal distribution out of income is exempt from IST. There is also an annual exemption amount of lifetime gifts, which is 3,000 for this year, and previous year annual exemption can also be brought forwarded if it is available. Certain reliefs are also given under capital gain taxes. For example, rollover relief, holdover relief, gift holdover relief, business asset disposal relief, investors relief, PPR exemptions, letting relief. All of these are the different reliefs and exemption in capital gain taxes. Whereas there are also, but for taking this relief, there is a common condition that asset must be a business asset. Except of PPR, except of letting relief, for all of the other reliefs, there is a basic condition that the asset must be a business asset. But for under IST, there are certain reliefs which are also available for business assets, but these reliefs has nothing to do with TX syllabus. These will be examined in ATX, right? As we have discussed few things with respect to CDT and IST, here we have a simple question, and the question requirement is to tell about the immediate implications, not the from start till end, but the immediate implications under IST and under CDT. So you need to consider this transaction, and you need to talk about the immediate tax implications for under both the taxes. What will happen if with this transaction, if we deal this transaction from the perspective of capital gain taxes, and what will happen with the same transaction if IST implications are applicable on the transaction. You guys are requested to read this scenario very carefully, and you need to tell the immediate IST and CDT implication on this transaction. Immediate IST and CDT implications. On 4th May 23, that's the fiscal year 23-24. This date in the fiscal year 23-24, on this day, he made a gift to his son. Gift to son. Son is from CGT perspective, it is a connected person, and from IST perspective, son is any asset transfer to a person is potentially exempt transfer. He transferred 15,000 pound one ordinary shares of this company, which is an unquoted investment company. From CDT purposes, unquoted company shares, from CDT perspective, unquoted company shares are always treated as a business asset. And if the transaction in between connected person and if the asset is a business asset, gift holdover relief may be claimed. Before the transfer, D owned 60,000 shares of the company from 100,000 share capital, and the company share price is dependent upon the shareholding. If the shareholding is 60% share, each share price will be 18 per share. If the shareholding is 45%, then the share price will be 10. And if the shareholding is 15%, then in that case, each share price will be 8 per share. He purchased 60,000 shares for 90,000 few years ago, assuming this is his first lifetime transfer ever. If you want to answer this question with like from CGT perspective, you will be writing that shares are gifted, and any transfer between connected person, whether it's a gift or at sale at less than market value, but the disposal must be recorded always at market value, because somewhere we have talked about that for CDD purposes market value of the asset, and for IST diminution in wealth concept is applicable. So shares are gifted to a connected person, and these shares are considered as a business asset because unquoted company shares are always treated as business asset. Second point, these gifted shares disposal is to be recorded at market value of 120,000. Now you would be thinking that where from I'm getting this 120,000? Look, he transferred basically 15% shares of the company. Company share capital is 100,000 shares, from which he transferred 15% shares, which represent 15% holding. Each share price will be 8 per share. So if 15,000 shares multiplied by 8 per share, so the disposal to be recorded the market value, and the market value of these shares will be 120,000. Thereafter, the gain on the disposal can be covered by gift hold over relief if both the persons are agreed to claim. Rest of the conditions are meeting. It's a transfer of in between connected persons, and the asset is a business asset. So gift hold over relief can be claimed if both the persons are agreed to claim. There will be no restriction. And if we want to deal the same transaction under IST, we will say that from IST perspective, that's a potentially exempt transfer. And any PT or CLT, any lifetime transfer asset value is calculated according to a concept named as diminution in state. You would be writing that value before gift. You need to take the value before gift, then compare value after gift. The difference will be the value of gift. Before gift, D owned 60,000 shares of the company and representing 60% of the holding of the company. If the shareholding is 60%, each share price will be 18. 60,000 shares into 18, 10,80,000 is the value of the shares before transfer. And from 60,000, he gifted 15,000 shares to son. And remaining shares will be 45,000, representing 45% holding of the company. And for 45% holding of the company, share price will be 10 per share, right? And 450,000 is the value after gift. So what's the difference? So that's the value of 15,000 shares. That's the value of gift, value 15,000 shares, value of PT will be 630,000. And this asset is being transferred in the fiscal year 23-24. So we can deduct the annual exemption of the transfer year. This year annual exemption is 3,000. Plus, at the same time, we can also deduct the previous year annual exemption. Nowhere it is mentioned that previous year exemption is available or not. If the question is silent, we can use previous year exemption. And if it is clearly mentioned that person has transferred an asset in previous year, then we shall not be taking that, because if person has already transferred an asset in previous year, so this exemption has already used against that transfer. So after deducting if, but with respect to previous year, if nowhere it is mentioned that previous year exemption is used or not, so we will be presuming that this is available and will deduct After deducting these two exemptions, net PAT value is calculated as 624,000, and immediate implications under IST for this asset will be, let me write, immediately any PAT in lifetime at time of transfer is exempt at transfer time. So there is no IST on this PAT at time of transfer. So we are also done with this petty question, but this question basically have made us recall two different areas, two different taxes, right?